Don't skip on tax preparation if you're planning on expatriating. I've been in the international tax business for over 20 years at this point, and I've been helping people expatriate for 15 years. And as part of what I do when a client's expatriating is I review all their tax returns to make sure that they're correct. Now, most of the clients that are expatriating already have some sort of international or foreign income and assets in preparation for their expatriation. As many of you may know, reporting foreign income and assets on a U.S. tax return is fairly complex, and there's not a lot of tax preparers out there that really know how to do it well.
Welcome to the Wealth Uncensored podcast, straight talk about everything that impacts your wealth. In each episode, I share what I've learned through my own experience and 2 decades of helping high net worth clients structure their affairs to minimize taxes and protect their assets for the next generation. I'll also feature special guests who are experts in their own field, sharing their knowledge and experience to help you protect what's yours. I'm your host, Jimmy Sexton. Let's dive into today's show.
And in the 15 years that I've been doing expatriations, I have never, not one single time, reviewed a client's tax returns and not found mistakes. Now, why is that important? It's important because after you expatriate, when you file your final tax return, you need to file a form called Form 8854. And Form 8854 has a checkbox on it where you have to check that you're tax compliant. If you don't certify under penalty of perjury that you're tax compliant, that can automatically trigger you to be a covered expatriate. There's other ways to be a covered expatriate, but I'm not going to go through those in those videos. If you're interested in all the ways of becoming an expatriate or a covered expatriate, check out my ultimate guide to expatriation. I'll put the link in the description. But the point is, you don't want to be a covered expatriate. So the very simple ways that you can become a covered expatriate is you have a net worth of $2 million or more, or you pay more than a certain amount of income, average income tax during the year, or you're not tax compliant. What does it mean if you're a covered expatriate? What it means is you have to pay an exit tax, which is a mark-to-market tax on your unrealized gains, and certain types of retirement deferred compensation accounts be taxed as distributed on the day before you expatriate. But maybe even worse for a lot of people expatriating, it means that if they give any gifts or leave any inheritance to you, any U.S. person, those gifts or inheritances are going to be subject to the highest gift or estate tax rate that in effect in the hands of the recipient. And the current highest gift and estate tax rate is 40%. So this is a significant amount of money. So I've seen a lot of situations where somebody's net worth is less than $2 million. They pay under the amount of average annual income tax. So by those 2 criteria, they are not covered expatriates, but they would be covered expatriates if they weren't tax compliant. And so that's why it's so important. You don't want to not check the box that you're tax compliant regardless of whether you meet the other criteria for being a covered expatriate. Even if there's no way that you can expatriate being a covered expatriate, you still want to be able to check that box that you're tax compliant, because if you can't check it, you're basically admitting to the IRS that you're not tax compliant. It's pretty easy for them to go, oh, look, this box isn't checked, and you're not tax compliant, let's audit this person. But when you're talking about non-covered expatriates, and they don't meet that criteria of being $2 million or more in net worth, and they don't pay over the average annual income tax, then they could still be a covered expatriate by virtue of not being tax compliant. And like I said, in my 15 years of helping people expatriate from the United States, I have never, not once, reviewed the person's tax returns and not found mistakes. That means if any of these clients had expatriated without me reviewing those returns and getting those returns fixed prior to expatriating, even if they didn't meet the other 2 criteria for being a covered expatriate, they would be a covered expatriate because they weren't tax compliant. Now, again, that subjects you to the exit tax, and any U.S. recipients of gifts or inheritances are going to be subject to gift or estate tax at the highest rate that in effect, which, like I said, currently is 40%. And a lot of people that expatriate, that's a big problem, because a lot of people that are expatriating may still have kids or relatives or something that are U.S. citizens that they may want to give gifts to or leave inheritances to in the future. And if they wind up being a covered expatriate, that's going to have huge consequences for those recipients of gifts who are U.S. persons or recipients of inheritances that are U.S. persons, right? So you want to be tax compliant. The problem and the reason why so many people are not tax compliant when they're getting ready to expatriate, and in truth, it's not just when they're getting ready to expatriate. Most people that file tax returns that have international income or assets that need to be reported, usually those returns have mistakes. And the reason that they have mistakes is because most tax preparers just aren't familiar with the rules for reporting and taxing international income and assets. It's a super complex area of the law. Most tax preparers don't want to lose business. None of us ever want to lose business. But you also have professional responsibility to only do work you're competent to do. And so a lot of times what happens is you have a taxpayer that's been using their U.S. tax preparer for many years, and they've always done a good job as long as all the income and assets were domestic. But then all of a sudden, this client expands overseas and starts having international income or foreign income and foreign assets, and then goes to this tax preparer, wants to get this prepared. Obviously, the tax preparer doesn't want to lose business, so they try to fumble their way through it. The problem is, if you don't do it day in and day out, and you don't have years of experience doing it and have just focused on international tax, you're just not going to do a good job on it. But how's the taxpayer supposed to know that? The taxpayer can't know that. They don't know what needs to be done to fill out these forms properly and how to calculate the tax on this foreign income and report the foreign assets. They have no idea. So they're relying on this tax preparer that's done a good job for them in the past, but is now out of their depth and fumbling their way through it. Another one is there's a lot of people out there that claim to be international tax experts, but just aren't. In order to be an international tax expert, it's not enough to just be a CPA or an enrolled agent or somebody who's been preparing tax returns for decades. You have to specialize in international tax. They don't teach all this international tax stuff when you go to school. This is something that you have to learn through experience and others, your superiors within your firm, teaching you how to do it so that you can do it properly. And the reason I'm making this video is because I have two people that are in the process of expatriating right now. Both of them, I reviewed the returns. There's inaccuracies and they need to be fixed. Now, a good, competent tax preparer that knows their way around international tax and knows how to properly report foreign income and foreign assets, they're expensive. They cost a lot of money. There's no way around it. You get what you pay for. You want it done right. It's gonna cost a lot of money. It's probably gonna cost several times what normal domestic tax preparation costs. And people are always shocked by this. And these clients I'm talking about, these aren't poor people. They can afford to pay this higher amount of money, but it's just so much more than what they're used to paying that they're trying to get his old tax preparer to fix it, and he keeps, preparing the return, sending me for review. We've gone through about 7 rounds of revisions, and they're still not right. And I keep telling the client, listen, you're spending more money on this guy to revise it and on me to review it than it would have cost you to begin with to just pay this other firm to have do it properly. And I get it, it's a lot of money, but the consequence of being a covered expatriate and having this exit tax and having your heirs and recipients of gifts who are U.S. persons subject to the highest gift and estate tax rate then in effect is a huge consequence. It can even have consequences. If you're not tax compliant, potentially it could have consequences if you try to get a U.S. visa to go back. And like I said, if you don't check that box that you're tax compliant, it's a clear sign the IRS to go, oh, this guy's not tax compliant, let's audit him. Or if you do check it, you're not tax compliant, then you've lied under penalty of perjury. And the same thing with the other client. The firm that I'm confident that will do a good job and that will do things properly is very expensive. He thinks it's too expensive, and so they're trying to go a different route. But the fee that's being quoted for the other route, it's just too low. There's just no way that a good job can be done at that fee. If you're planning on expatriating, you want to be tax compliant. First thing you need to review when you're getting ready to expatriate, because if you're going to be a covered expatriate no matter what, you still want to be able to check that box so you're tax compliant, because if you don't, it's an easy indicator for the IRS, let's audit this dude. You're not otherwise a covered expatriate, then you definitely want to be able to check that box so you're tax compliant, because otherwise you're going to be a covered expatriate, be subject to the market exit tax, as well as your heirs and recipients of gifts or U.S. persons being subject to gift or estate tax at the highest rate then in effect. So my advice to anybody who's considering expatriation, the very first thing you need to do is whoever you're hiring to advise you on this, needs to be somebody that's competent to review the returns and make sure that they're done properly. And even if your advisor, for example, is maybe a tax advisor, tax lawyer, something like this, that is not a tax return preparer and doesn't know their way around tax forms, then they need to make sure to put you in touch with somebody that's truly an international tax expert at preparing tax returns that can review them and make sure that they're correct. And if they're not, correct them and spend the money to do it right. In the long term, when you think about years down the road after having expatriated, in the long term, it's money well spent. Like, I realize it can be expensive to do this. I realize it can be painful, but in the big scheme of things, it's well worth it to spend the money to fix your tax returns before you expatriate so that you can confidently expatriate knowing that you're tax compliant. Anyway, I hope you found this video informative. Stay tuned for the next episode in the near future.
Thank you for joining me on Wealth Uncensored, where we help you minimize taxes and protect your wealth for the next generation. If you like our show, be sure to subscribe and leave a review. And if you have any questions or suggestions for future episodes, we'd love to hear from you. You can email us at info@esquiregroup.com. And don't forget to visit Esquire Group's website for more information on how we can help you secure your wealth. I'll be dropping knowledge again next week. Don't forget to join us.